Hello, everybody, and welcome to the 2022 housing forecast. I'm Matt Wright, Alliance West Mortgage, and I am excited to bring this presentation to you because, frankly, this is going to be a pretty exciting year. So what I'm looking to accomplish today is to just take a deep dive into what's happening, what's coming, and kind of try to take a look into the crystal ball to forecast to see what's ahead for this year, specifically covering the housing market, interest rates, inflation, and a forecast of really what to expect. So let's start off with where we were a year ago. Interest rates forecasted in the beginning of 2021 were that they were expected to rise in the beginning of the year and then recover into the fall. A lot of this had to do with everything that was happening with COVID at the time. And the actual was that rates did sharply rise up through March as anticipated, but recovered a bit earlier. It seemed that it had a lot to do with the Delta variant that really came out of nowhere and shocked the markets, and so that drove rates back down. So we did see some gains recovered. Basically by the end of summer, we were back to where we were initially, and since then, rates have pushed higher. As far as housing is concerned, forecast was that there'd be strong demand and tight supply. And that would push home prices up. Solid appreciation for the year was expected. Actual, very, very strong demand, and even tighter supply than expected. And, COVID causing supply chain disruptions and labor shortages pushed real estate values even higher. We also had some very, very low interest rates, which helped move property values higher as well. So 2022, we've got some very interesting dynamics. Mainly the Federal Reserve is going to play a major role in what happens this year with interest rates and really everything for that matter. If anything, they will probably be the most influential driver of what we expect to see in global financial markets, housing, interest rates, etc. So, and one of the main reasons for that is because as of right now, inflation is at the highest levels in over 40 years. So inflation is defined as a progressive increase in the prices of goods and services in an economy, resulting in a reduction in the purchasing power of that economy's currency. So effectively means that dollars are worth less. You cannot buy as much for the same dollar that you had a year ago that you can today. So the things that are affecting inflation are right now, supply chain disruption. We have labor force shortages. There's the term thrown around right now that we're looking at the great resignation or the big quit because people are quitting their jobs at insane levels that have never been seen before. I think it was 12 million plus people quit their jobs in the last 3 or 4 months of the year, which is just crazy. People are rethinking their careers, what they want to do, how they want to work. So long-term goals are changing, and a lot of people were on unemployment and extended pandemic unemployment benefits that they were making more staying at home than they were going to work. And also COVID, people didn't want to go back to work in a COVID environment. So it's hard to get workers. And, when employers have to pay more to recruit, that ends up costing more to the consumer and drives the price of things up. In addition to that, we have semiconductor or chip shortages on everything. I mean, pretty much everything needs a computer chip these days. And so, the fact that we can't get them is causing the price of those products to go up because demand is still there. Additionally, there's an unconscionable amount of stimulus that has been pumped in the economy over the last couple of years. There's a $2 trillion spending bill, getting negotiated in Congress right now. And we'll see what effect that has, but all these factors are contributing to inflation. And for mortgage rates, mortgages hate inflation. The reason being is it erodes the return that you get. So if you're buying with a fixed budget, let's say that you were retired and you owned a mortgage note that was paying you 3%. Well, if inflation is at 7%, which is where it is right now, you're basically have a 4% gap in what your return is. So your dollars are not going as far. So in a normal market, mortgage rates would have to go up to where the inflation rate is at least in order to have someone be willing to buy those mortgages. And there's an external factor right now, which is the Federal Reserve that's keeping rates down and not allowing the markets to function as they normally would. And we're going to get into that here shortly. So anyway, long story short, mortgages, you just don't have much buying power. So when there's inflation, mortgage rates have to go up. As far as the Federal Reserve is concerned, there's three main things that are going to be happening this year. Number one being tapering. And so right now, the Federal Reserve is buying billions and billions of dollars in treasuries, government bonds, essentially, and mortgage-backed securities. So that's been keeping rates low. They're going to be stopping that. Likely by March, they're not going to be buying any more. So that demand will be leaving the bond markets. In addition to that, we're looking at probably, I'd say, 3 rate hikes this year, short-term rate hikes. These are not mortgage rate hikes. These the rates that the Federal Reserve controls are the rates that the banks can borrow from each other and from the Federal Reserve. And they're going to be increasing rates, making money more expensive, tightening, and that affects everything. And additionally, balance sheet runoff for the Federal Reserve. And I'm going to get into that a little bit more shortly. So these things can and will affect equity markets, interest rates, impact housing, as well as jobs. Additionally, we've got 4 new voting members being rotated into the Federal Reserve because they, I think there's 19 members and only 12 of them are voting. So 4 new members will be rotating this year. And these 4 members are less accommodative than the ones that are rotating out. And what I mean by that is that they will be less likely to be for or voting for additional stimulus or continuing stimulus. So that could contract and push rates up. So right now, the Federal Reserve main job is control inflation and reach max employment. So they need to do something about this inflation. This is the main focus. And usually when we have a fight against inflation, the stock market doesn't like it. And we could see the Fed lose some resolve here. So the Fed should have hiked sooner. There's no doubt about that. There's this term transitory inflation that's been tossed around for the last year or so, thinking that just coming out of COVID, that the inflation was transitionary as we get back to a normal state. But as we all can see now, this is not transitory, temporary, transitional. It is here, and they need to do something about it. So, history can help us forecast how the Fed's actions in 2022 are going to influence the markets because, history repeats itself. So if we look back into the late 70s, Arthur Burns was the Federal Reserve chairman. At the time, he ignored inflation. It ballooned from 7% in 1978 to 14% when he left in 1980. Mortgage rates jumped from 12% to 18%, and he said it was transitory. So does that sound familiar? Yeah. So next came in Paul Volcker, and he had to go to war against inflation, and he hiked the Fed funds rate, which is the rate that the Federal Reserve can control, from 11 to 20% in 2 years. Inflation dropped, and mortgage rates sharply declined from 18 to 12%. So it worked. However, there are consequences to this. So the S&P 500 dropped 30%. In addition to that, the tighter monetary policy pushed the country into recession in 1982. So next inflationary situation was with Alan Greenspan in the late 90s. Inflation went from 1.75 to 3.5%, pushing mortgage rates up from 7% to 8.5%. Mid-99, he hiked the Fed funds rate 1.75% to match the rise in inflation that was happening. Inflation dropped after that, shortly after, from 8.5% to 1%. It worked. However, again, there were consequences. The S&P 500 fell 50% during this time, just a few months after, leading the US into recession in 2001. So today, under Jerome Powell, current Fed chair, we've seen inflation increase from 1.75 to 7%. We've heard this term transitory over and over and over, transitional, temporary, whatever you want to call it. It's just a fancy word. It's not, they're going to have to do something here. And we've seen mortgage rates rise from 2.5% to 3.375, probably even higher than that in a lot of scenarios right now, just based on how the bond markets have been behaving in just this week. The Fed is currently tapering their purchase of mortgage-backed securities and government bonds or treasuries. So, they're buying approximately 120 billion a month in mortgages and treasuries 40 billion of that 120 are mortgages, 80 billion in treasuries. So they're going to be reducing that, and probably by March, they will not be buying anything. So that demand leaving the bond markets should cause prices of these bonds to go down, and rates or the yield on these bonds to go up, pushing mortgage rates higher. So I also anticipate seeing rate hikes, probably 3 this year, starting in May, in probably 2 or 3 in 2023 as well. So inflation and interest rates can still rise until the Fed acts. If the Fed can tame inflation, then mortgage rates should drop, but it may be from higher levels that we're at right now. The wild cards this year are COVID. This virus continues to adapt, mutate, change, and we're seeing changes in all over the world with things that we've never seen before in the past. So, if something else, a more deadly variation or variant comes out, that's going to change everything. So, the outlook could change dramatically with any, big surprise in COVID. Additional stimulus could cause higher inflation. Again, I mentioned earlier that there's a $2 trillion spending bill floating around in Congress right now. If that passes, it's just more money flooding into the system that will push the prices of things higher and cause the inflation rate to go up. That could also bring mortgages up with it. So, and make the end job of the Federal Reserve even more difficult. So, as of right now, it seems like that bill is not going to pass, but we'll see what happens. In addition to that, we're going to be looking at a runoff on the Federal Reserve's balance sheet. So, we mentioned earlier, there's tapering, there's rate hikes, and there's balance sheet runoff. So the Federal Reserve has a $9 trillion balance sheet. They have $9 trillion in assets. A lot of that consists of treasuries and mortgages. So what happens especially in an environment like this, when rates are low, is that the balance sheet will run off when these loans get paid. So if someone refinances or sells their house, the balance sheet will run off or be decreased by that amount because the loans are now paid in full. So what the Federal Reserve is doing right now is they're not allowing the balance sheet to run off. They're repurchasing everything that pays off so that the balance sheet stays at the same level. So even though they're buying 120 or say 40 billion in additional mortgages a month right now that ends in March, they're also buying another 70 billion a month in mortgages because of the runoff. So that will be the last step of their assistance, if you will, to get out of interacting in the financial markets or keeping things in check. So first step, stop purchasing or tapering their new bonds and new mortgages and treasuries. Next step will be rate hikes. They're still going to be replacing the runoff that happens. Eventually, they're going to stop that too. So major money that is coming in from the Federal Reserve, buying mortgages, that has been keeping rates this low for the last couple of years. When that goes away, we expect that rates are going to go up. So stock market, as of now, it's overvalued on pretty much every metric imaginable. More money that comes into the system, you expect stock market to continue to go up. If rate hikes go into play, usually the stock market doesn't like this, and we would expect to see the stock market decline. So rate hikes could cause price to earnings multiples to contract, resulting in lower stock prices. So I'd expect that we could see a negative year for the S&P 500 or really any major index. But of course, there are variables to that, and we'll have to see how everything plays out. But that's the way it looks right now. Interest rate forecast, I'm anticipating to see mortgage rates rise into the high 3% this year. We've already started to see it, just in the first 3 days of 2022 bond trading, or mortgage-backed securities trading, the market's just gotten clobbered. So rates are already pushing higher, and so it's likely to continue as we go through this year. With Fed action, we should see a softer stock market and slowing economic conditions because of that. And interest rates will likely head lower because of that. That's kind of what happens when the stock market takes a hit. A lot of the funds that are leaving these stocks go into fixed income, or where it's safer bet, and that's where mortgages trade. And when there's a lot of demand for those bonds or mortgages, the prices go up and the yields or the rates go down, and that rate will be what a consumer can get on a mortgage. So again, forecast for rates to rise towards, high threes, 3.75, maybe a little bit higher than that. We'll see, just based on what we're seeing right now in the first half of the year, and then decline, towards maybe 3% as the Fed rate hikes. So, I want to point some out here. I said that rates are going to decline on mortgages as the Fed hikes rates. So as the short-term rates get, increased, long-term rates, mortgages go down. And, again, a reason for that is because it usually affects the stock market. And, there's a flee to safety to mortgages because they're a safer bet. And so that brings long-term rates down. And that happens, quite often when the Fed hikes rates, mortgages go down. So strategically, this does set up buyers in today's market for a refinance opportunity ahead. I do think that rates are going to go up and then they come down. So someone's buying a house right now could, get whatever rates available and be looking to refinance within the next year or two. So housing forecast, housing is going to remain real strong in 2022. I don't think it's going to be as strong as it was last year. Last year was absolutely bananas, and it'll probably tame out a little bit this year. So, demand may be slightly softer due to a rise in interest rates as well, but still robust. And we should see some supply increase, but remain tight. The lack of inventory has sidelined many buyers and sellers from making a move. It's a tough market to buy a home in. Selling a home is easy for the most part, but buying a home is tough. There's not a lot of selection, super competitive, and that's brutal for a lot of buyers out there. So, and just to give you an insight into the supply or inventory crisis, in my local market here in Orange County, California, we finished 2021 with about 1,000 homes in active inventory. This is the lowest active inventory level on record. And this is 60% lower than it was at last year's record low of about 2,700 homes in active inventory at the beginning of the year. So incredibly low inventory. Peak for 2021 was about 2,500, and the 5-year average peak pre-COVID was over 7,000. So nearly 3 times less inventory than the last 5 years pre-COVID. So, inventory is tough. That's going to continue. I think we're going to see some more supply, which will help, but it's not going to be, anything normal. Also, we also have an issue with the appreciation in prices and, interest rates coming up for the buyers that are looking to move up, sell a property and maybe buy something more expensive or larger. Those buyers are having a hard time going from, a 2.75% interest rate to maybe 3.5%. Plus, they're going to have an increase in their property taxes. It's just a tough pill to swallow. So a lot of these homeowners are just sitting tight and, remodeling and doing different things to the house instead of selling. So we'll see how that plays out as well. In addition to that, the tight labor supply chain issues, and chip shortages are affecting new construction because, again, everything needs a computer chip. And if they can't get them, they can't buy dishwashers, they can't buy, stoves or everything, whatever they need to put in a new home. If they can't get it, then they can't sell the house. And so that's, putting a strain on new home sales as well. Rents are for sure going to continue to rise this year. Rents have not, caught up to the increases in home prices. So I would anticipate at least 5% increase in rents this year. And that's a real incentive for buyers or renters to go out and look to buy. So, I would strongly be looking at renters this year. I just talked to a client yesterday that is seeing, I think it was a 7% increase in rent this year. They desperately want to buy. So, a great market to look at. So forecast for property appreciation, I'd say, somewhere in the high single digits. I almost hope that we don't see anything more than that. It just depends on where rates go, I would say. And so we'll see what happens, but still, a great wealth opportunity for anyone that's looking to buy. We're going to see solid appreciation this year too. So that being said, that's it for the 2022 housing forecast. I want to thank you all for watching and listening. I hope this information was helpful and that you can utilize it in your day-to-day. If you have any questions, concerns, any criticisms, I'd love to chat about it. Please feel free to reach out. My direct number, cell, is 949-395-0140. Once again, Matt Wright, Alliance West Mortgage. Thank you all so much for your partnership. I look forward to working with you this year. And I think it's going to be a great and successful 2022. So cheers to that. And we'll talk soon. Take care.